Welcome to our class. We would like us to look at the books of original entry, and also we look at the cash book. Let's start with the definition of the books of original entry. Books of original entry are the books which are used to record all transactions of a particular category prior to posting to the ledgers. Books where all transactions of a particular category prior to posting to the ledgers are recorded. So those are the books of original entry. So we call them initial books. The initial books where transactions are recorded first before they are posted to the ledger. There are two categories. We have those which are used to record credit transactions and those which are used to record cash transactions. The one which is used to record the credit transactions, we have the purchases daybook or journal, which is used to record the details and amounts of all goods purchased on credit. And then we have sales daybook or journal, which records the details and amounts of all goods sold on credit. Then we have the purchases return daybook or returns outwards daybook, which is used to record the details and amounts of goods returned to the creditors. Also, we have the sales return daybook, or we call it returns inwards journal, which is used to record the details and amounts of goods returned by the debtors. Then we have the petty cash book. The petty cash book is a book which records the small cash receipts or payments. So this book is also used to analyze the expenses paid in cash. It is used to analyze the expenses paid in cash. Then we have the journal or diary, also we call it the general journal or proper journal. This journal is a day book in which we can record the details of any transaction that cannot be recorded in any of the subsidiary books which you have already learned. Any transaction which cannot be recorded in the journals which you have already mentioned, they are recorded in the journal proper, or we call it the diary. Let's look at the main uses of the journal or the daybook. Mostly daybooks are used to record purchases or sales of assets. So we also call it the general journal. This general journal is, we say it is used to record the transactions which cannot be recorded in the other channels. So in most cases, the transaction which cannot be recorded in the purchases, sales, returns, journals, they are recorded in the general journal. So these transactions include the purchase or sale of fixed assets. So we have the correction of errors. When you are correcting errors, you cannot correct an error using the purchases or sales daybook. You use the general journal to correct the errors. Also, we use the general journal to record opening and closing entries. We record opening and closing entries in the general journal or the diary. So in this diary or the journals or daybooks, we also call them the subsidiary books or books of original entry or books of account. So they have 5 columns. The first column, we write the date. Second column, we write the particulars or details. Then we have invoice number or credit note number. Then we have the folio column and the amount column. Okay, it has only one side. It doesn't have two sides as the ledger. Just only one side. So that side has 5 columns. So say the first column you indicate the date, the second column details, and that column you write invoice number or credit note number. Then you have the folio and amount. So, for example, if you want to prepare a purchases journal, you use invoice number. Purchases journal and also the sales journal, we use invoice number. For the returns journals, we use credit note number. Credit note number. That is the difference. So because of that, I would like us to look at the cash book. The cash book. So as I've said, cash book is also a journal. Mostly the cash book journal is used to record cash receipts and cash payments. Cash receipts and cash payment. So a cash book can be used as a journal, that's a book of account, and also a ledger. So it is used to record all the cash transactions. Cash transactions meaning cash receipts and cash payments. So I've said the cash book is a book of account where cash transactions are being recorded. So let us look at the cash book. The cash book. See that the cash book is a book in which cash receipts and the payments are recorded. It's a book in which cash receipts and cash payments are recorded. So a business enterprise may find it more convenient to open a business account, a business bank account, instead of receiving cash in hand. The money can be deposited in the bank. So even bank, we classify it under cash. That's why we call it cash at the bank. So the cash book is going to deal with the cash in hand and cash at the bank. Cash in hand and cash at the bank. So to that, I would like us to look at the types of cash books. So we have single or one column cash book. We have 2 or double column cash book. We have 3 or triple column cash book. And we have the petty cash book. So one column cash book, it is a cash book with only one money column. A cash book which has only one money column. So it's just like the ledger, whereby the money which has been received or paid in cash is recorded in one ledger, which we call cash account, and the amount which deals with the payments using check or the deposits made through the bank, we record in the bank account. So because we have already learned about the ledgers, the one column cash book is just like the ledger. It follows all the rules of the double entry, and it has only one money column, which we call amount. Only one money column, which we call amount. Okay, let's look at the 2 column cash book. The one which we said, we also call it double columns cash book. So in the 2 column cash book, instead of preparing the cash account and the bank account separately, they are prepared in one sheet or one page. So the cash and the bank accounts They are opened in different parts in the one column cash book, but in two column cash book, they are prepared in one page. So this cash book, this two column cash book has two money columns. It has two money columns. So instead of writing amount, these money columns, they are divided into two. We have cash and we have bank. So the money column is divided into two, bank and cash. Any transaction involving the bank is recorded in the bank column. And any transaction which involves receipt or payment in cash, you record in the cash column. Then the two column cash book, we have the contra entries. In two column cash book, the payment of cash into bank and the withdrawal of cash from the bank or from the bank account are recorded on the same page, but on the opposite sides. So these transactions, we call them contra entries. So instead of writing the whole words, like now contra entries, we just indicate letter C, capital C, meaning those transactions are contra entries. When you take money to the account or when you take money to the bank, it means it can affect cash and it will affect bank, because you have taken money from the cash account that's in the office, you have taken it to the bank. So the money in the office will reduce and the money in the bank will increase. So it has two effects on the same page. That is, it affects the same cash book on the same date. That's why we call it contra entries. Also, in the same case, when you withdraw money from the bank, you take the business, it will affect both the bank account and the cash account, meaning money in the bank will reduce and the money in the business, cash still, will increase. That's a contra entry. Let's look at the three column cash book. Three column cash book is a cash book which has three money columns. That's three money columns. These three money columns, we have an additional column which we call discount column. Discount column on both sides, debit and credit sides. So we have the cash column, we have the bank column, and we have the discount column. So when we say discount, we mean an allowance. A discount is just an allowance given to a trader on the goods purchased. The allowance given to the trader or the customer on the goods purchased. For example, if you are a trader, you are buying goods for selling, you are given allowance for you to get a profit. That allowance which you see, we call it trade discount. So we have all kinds of discounts. We have trade discount, we have quantity discount, and we have the cash discount. So the trade discount is that allowance which is given to a trader or the person who buys goods for selling in order for him or her to make a profit when he sells at the bar price. So for example, you are buying goods, you are buying, let's say, exercise books for selling. The supplier will allow you some amount, by reducing the price for you, so that when you are going to sell at the retail price, you get a profit. So that allowance which the supplier gives to the trader is what we refer to as trade discount. Then we have the quantity discount. Quantity discount start allowance, which is given to a buyer or a customer who buys goods in bulk, who buys goods in large quantities. If you buy goods in large quantities, you receive quantity discount. Even if you are not going to resell, but you have bought in large quantities, you receive quantity discount. So quantity discount is given to all the consumers and the traders or the retailers and wholesalers. Okay, now we have the cash discount. That's where one task to dwell in, because that's the discount which affect the cash book. So the cash discount is that allowance which is given to a trader to induce that trader to pay the accounts promptly. So you give a cash discount to a trader so that you make that trader to pay their debts in time. So within a given trade period, or you can also call it discount period. So for example, in most cases, cash discount is given to those people or traders who pay within 30 days. Okay, so we have two types of cash discounts. We have discount allowed and discount received. Discount allowed and discount received. As a business, remember you are buying goods for reselling. So when you buy goods, you receive a discount. When you sell the goods, you allow a discount. So these discounts affect the cash flow. Let's start with the discount allowed. Now the discount allowed is the discount which is given to the debtors. It's given to debtors. When you give the discount to a debtor, it means it's going to be a loss to the business. It is reducing your profits. It will reduce your profit, so it will affect the cash book in a negative way. Okay. Discount allowed or received is the discount which is given or is received from the creditors. Discount received from the creditors. When you buy goods on credit, the suppliers of credit goods will give you a discount in order to make you to pay within the stipulated time. So it is regarded as a gain at the end of the accounting period, and it is shown on the credit side of the profit and loss account as a gain. Discount received is a gain. It will increase your profits. So in the profit and loss account, we say it is supposed to be increasing your profit. So you credit it as a revenue. Okay. So I've said this cash discounts frequently, cash discounts occur frequently. And instead of making so many entries in the discount allowed and discount received account, it is more convenient to make one entry for 1 month in these accounts. So for this purpose, a cash discount column is being added to the cash book on each side. So in the debit side of the cash book, because you usually write the receipts on the debit side of the cash book. So when you receive, meaning you are selling, when you are selling goods, you receive cash, you are the one to allow discount. So discount allowed is written on the debit side of the cash, 3-column cash book. Then discount received, we said you are getting it from your creditors. So when you purchase, is when you receive a discount. Purchases are like payments because you are giving out money. So you record on the credit side of the cash book. So on the credit side of the cash book, that's where you record the discount received. Discount received on the credit side and discount allowed on the debit side. look at the petty cash book. Now, the petty cash book, I said a petty cash book is a cash book where small receipts and payments of cash are recorded. So all the payments which require little amount of money are recorded in the petty cash book. This petty cash book has a different format. On the receipt side, we have only one entry, meaning the amount which has been received from the general cashier is recorded on the debit side, which we call receipts. Then all the payments which have been made are recorded on the credit side. We call them analytical columns. So for each expense, we have a column, a separate column. Each expense is recorded in a separate column. Then we have the total column. Okay, we have the details column, only one detail column, which we serve for both receipt and payments. So due to that, I would like us to look at the petty cash book and the interest system. Petty cash book and the interest system. So when we say interest system, we mean that it's a system whereby the general cashier gives the petty cashier some amount of money to spend on behalf of the organization. This amount of money given to the petty cashier is written in the budget, so it's predetermined that it should be the same all throughout the year until the budget is implemented. Okay, so the general cashier gives the petty cashier some amount of money to spend on behalf of the organization. Then the petty cashier will be making payments, and after making the payments, he has to record the transactions in the petty cash book. At the end of the year, at the end of the month, in most cases, at the end of the month, the petty cashier will calculate and check the amount we then he gets a total. Now, the total payment is subtracted from the amount which was given, which we call the cash fraud, to get the difference, what is the balance carried down. Then the balance carried down, accompanied with the evidence, that is the vouchers and the receipts, are given back to the general cashier to scrutinize, but to check whether the transactions occurred. If now the general cashier is satisfied with the evidence, he has to reimburse. He has to reimburse the amount which has been spent by the petty cashier to the petty cashier. So the reimbursement amount plus the cash balance will be given back to the petty cashier to spend for the next period. So this reimbursed amount plus the cash balance will give us the total amount to be spent for the next period, which we call the cash fraud. Then the system will repeat itself continuously until the policy has been changed. That is about the interest system. So because of that, I want us to end there. Then next time we are going to do another topic. Next one, join our class every time so that we continue together.